The people behind the Pump.fun ecosystem are quite smart. Not only have they launched one of the most successful platforms in all of crypto, the leading Memecoin launchpad on Solana, they also now have initiated a buyback program of the Pump token that's actually successful at supporting the price. So many teams have tried similar approaches, tried to implement burn mechanisms to turn around a negative momentum. For most projects, this fails. But for Pump, it didn't fail. For Pump, we do see a recovery. Now, I've been covering the Pump token regularly on this channel, and the videos tend to get quite a lot of attention. They tend to outperform the average video on this channel. And initially, the launch of Pump did not look pretty at all. It was one of the most hated ICOs. The Pump token fell by 66% from 0.68 cents to 0.23 cents. Here's Pump relative to Solana. We do see slightly higher lows over time. And if the top after launch is any indication, we might potentially see 80% outperformance versus Solana in the next weeks. Now, why did we see this dump in the price in the first place? It's because many people were very concerned about the tokenomics of the Pump token. Have a look at this. This is Tokenomics.ai, the number of circulating Pump tokens over time, and especially the potential upcoming airdrop was a cause of concern. But the team has reacted. The airdrop has been postponed and the platform got major upgrades, among them being the dynamic fee upgrade that makes the launch of very small, potentially not so viable assets very expensive. And so here's then what happened to the creator fees subsequently. They spiked up, and now the project is buying back Pump tokens at a similar rate that revenue is generated. So how much is that per day? It's roughly $2 million worth of Pump that gets pushed into the asset. And the very encouraging thing about this buyback program is that the fees are actually growing over time. The total value locked, so the amount of capital that's in Pump swap, is growing, but not just that, also the fee generation is growing. So the TVL is in blue, the generated fees is in red, and so what looked like very hostile tokenomics with this buyback program now looks rather attractive. The major concern had been addressed. And so now Pump is the second largest trending token in terms of liquidity on the Solana chain. Only Fartcoin is slightly higher, but there's a good chance that Pump will get to number one rather sooner than later. Have a look at the trading volume on the Solana chain in the last 24 hours. We had 8.9 billion. How much of that was on Pump swap? It's 6.6 billion. Now, it's very hard to say how much of this trading volume is actually naturally occurring, is organic, and how much of this is artificially heightened, potentially due to wash trading, potentially due to figuring out how to get some attention on individual tokens. So this might not necessarily be all organic, but it's still currently growing revenue, and that's supporting Pump. On the chain itself, we actually do not see that many transactions. So have a look at this. This is the Pump token on Pump swap. There was only 600 wallets that interacted with the token in the last 24 hours. Yes, in the last month, the number of token transactions is going up, but the number of first-time traders is relatively flat. What we see here on the left is the trading volume of Pump over time in US dollars. And on the right, it's normalized to 100%. So you can see the different segregation, like how large are currently the wallets that are trading the Pump token on the chain. Initially, there was a lot of excitement around Pump, and then that excitement went down. And even though the price recovered, it's not that the trading volume of the Pump token itself recovered. It's actually rather small retail that's taking over more and more of the trading volume. So really, this is a buyback-driven rally. This is not purchases that happen through the masses on chain. But yeah, interestingly enough, it's mainly the small retail investor that's interested in that buyback program, that's also buying on the back of it. On the left side, we see the number of wallets that have at least 170,000 Pump tokens. So at the current price, it's roughly $1,000 worth of the token. For the chart in the middle, we go a 10x from that. So that's $10,000 worth of the token. On the right, another 10x. So that's $100,000 worth of the token. We can clearly see that small retail tends to accumulate the fastest, or the number of small retail investors is going up the fastest with that buyback program. We do not see the same for the whales. Now, besides the purchases that happen through the buyback program, we of course also have the perpetual futures, so the short-term leverage in the price. How much of the current rally is currently due to that leverage? Let's have a look. So in the last 24 hours, we saw spot trading volume of 111 million on Bybit. But on the perpetual futures market, we saw more trading volume. We saw 660 million, and that's on OKX. Most perpetual futures traders that bet on the pump price with leverage tend to bet on rising prices. So the longs have to pay the shorts. The funding rate is positive. The open interest on pump did slightly go up with the recent rally, but relatively speaking, it did not go up as much as the price. So the spot price increased slightly faster than the open interest. The trading volume on the perpetual futures isn't that elevated either. And so really the fundamental question is, how long will this buyback program stay in place? Is the team happy with the current recovery, or does it want Pump to outperform Solana long term? And will it keep the buyback program running? If the latter is the case, then there's still a lot of upside versus Solana. Here's a similar chart. This is Pump relative to the others market cap. So how is the Pump token doing in comparison to other altcoins? And again, since the implementation of the buyback program, Pump is doing pretty well. Some retail investors get encouraged by that buyback program and buy as well. The whales just stay put. But I think it makes sense to continue monitoring this chart. I will of course cover this regularly here on this channel as well. I publish videos on the Pump token regularly over here. Feel free to subscribe. This chart, by the way, is available at fees.pump.fun. In total, we have so far seen 87 million worth of Pump getting purchased via the program. Besides all the medium and short-term price movements, it's also always interesting to see what happens long-term. What kind of assets can we actually hold over the years? Because once we know that, we know what to do during times of potential sell-off. I think, for example, that there's no question that Bitcoin long-term will appreciate in US dollars. Have a look at the percent of Bitcoin supply that has not moved in the last 5 years. This fraction tends to increase long-term over time. So there's less and less Bitcoin that's available for active trading. At the same time, we see more and more Bitcoin getting purchased by the treasury companies. And we've got the ETFs on top of that. So one might argue that roughly 30% of Bitcoin supply is in the diamond hands, or it's completely lost. At least net, this chart is unlikely going to go down significantly. We've got more than 5% in the hands of the treasury companies, and we've got roughly 7% of the supply held by the ETFs. So that means more than 40% of Bitcoin supply is in the hands of entities that tend to just stack away their Bitcoin over time. All of those curves tend to go up over time. They tend to not go down. And again, this reduces supply. This increases the value. Yes, there is Bitcoin mining of 0.83% per annum, but that mining is much slower compared to the rate of lost Bitcoin or of accumulated Bitcoin through the treasury companies or through the ETFs. And so this is where crypto and especially Bitcoin differentiates itself from other asset classes. For many other asset classes, we see as prices go up that it's mainly the short-term investor that wants to make a quick buck. But we can see with the Bitcoin rally from recently 16K to above 100K that it's the long-term holders that tend to just accumulate over time that are causing the rally. So that's what we want, right? We want that the people that buy an asset, they're not selling it anymore in the future, at least in aggregate. And this is, I believe, what we see with Bitcoin. And so I don't think it's a real question whether or not Bitcoin will appreciate in the future, especially versus the US dollar, because the US dollar has an expanding supply. It tends to grow by roughly 6.8% per annum. So this is USM2. This is official numbers by the Federal Reserve. If we look at the money supply in 1959 and compare this with the money supply today, within 60 years, the monetary base expanded by 77x, which is an annual growth of 6.8%, which, by the way, is the majority of the return of the stock market as well. Most of the stock market return is just monetary debasement. And so when Bitcoin becomes more and more rare over time because of those entities and the fiat base grows more and more, then the most straightforward approach would be to simply use the same kind of investment tactics that we have for other asset classes, right? For the stock market, for example, we've got our savings plans, our 401ks, or for property, we've got our mortgage payments, where again, we pay in regularly with our cash flow. We can do the same for Bitcoin. For Bitcoin, it's typically called dollar cost averaging. So for example, if we buy $1,000 worth of BTC and we do this for the long term, as we do with property and as we do with the stock market as well. if we just expand our time horizon to say 6 years, so beyond a cycle typically for Bitcoin, then it's extremely likely that over time we are outperforming classical investment approaches, because again, Bitcoin becomes more rare over time and it still gets more and more adoption. Had you followed this $1,000 per month approach with the S&P 500 or with gold, and you did this for 6 years, you'd be at somewhere around 120, 130k now. Had you done the same for Bitcoin, you'd now be at 360k. So roughly 3x the amount. And so this is where Bitcoin differentiates itself massively from the altcoin market. With the altcoins, we do not know what will be around still in 6 years, what will still be relevant in 6 years. The altcoins are highly inflationary, as in projects issue new tokens over time so that venture capitalists can sell their tokens, so that the team can sell their tokens. There are vesting unlocks. And when we look at the entire market, the entire altcoin market that's tracked here on Tokenomics AI, we've got unlocks of roughly 1 billion per week. So as long as we don't see 1 billion of purchases every single week in the altcoins, the prices of the altcoins are going down. Now, how much is 1 billion per week? Let's compare this with Bitcoin. Bitcoin has a market cap of 2.27 trillion and it's got an inflation rate of 0.83%, which by the way is debatable because again, we've got the purchases by all of those other entities and we've got the Bitcoin that gets lost. But let's ignore all of this. Let's just say this doesn't exist. Let's say we really have a net issuance of those 0.83% on the 2.27 trillion. If we run the numbers, we've got selling pressure of 371 million per week. So roughly a third of what the altcoins have as selling pressure. Now, how likely is it that the altcoins in aggregate get purchased at 3 times the rate of Bitcoin when Bitcoin already has this direct link to Wall Street? I think the likelihood is rather low. On top of that, the Bitcoin market cap is roughly 7 times the market cap of the altcoins. So the selling pressure is only 1/3. The market cap is 7 times as large. So really, relatively speaking, the altcoins have an inflation rate that's 20 times larger. And that's what's causing this situation. This is the smaller altcoins, the performance in the last year. Bitcoin has roughly doubled in the last year. And just have a look at how many altcoins that are shown here have doubled. There's 1, 2, 3 altcoins that did roughly the same as Bitcoin. There's only one outperformer. The rest all massively underperformed. And this is not a coincidence. This is simply just capital concentration towards the long-term winner in the market. You can't buy Quick or Myro or Pika or Atlas for $1,000 every month and just use this as another savings vehicle. Dollar cost averaging into those assets doesn't make sense, but dollar cost averaging into Bitcoin or Ethereum very much makes sense. And so I'm taking advantage of this capital concentration process. I'm betting on most altcoins doing worse than Bitcoin over time. And that's how I create additional alpha over just buying and holding Bitcoin. I don't just dollar cost average into Bitcoin, I dollar cost average into my trading portfolio, and I buy Bitcoin and Ethereum and Solana, and I sell or short sell all the bad altcoins over time. So this is my active trading portfolio measured in BTC. And of course, there is a lot of dollar cost averaging happening here as well. There's additional capital that enters this portfolio every month. But had I not dollar cost averaged at all, then because of my relative valuation trades, I still doubled the money. So without the relative valuation trades, my portfolio would now be only at around 2.5 Bitcoin instead of 5 Bitcoin. That's the kind of impact that's doable after 4 years of following such a strategy. So basically take this DCA approach and just 2x that capital. That's then 720k versus just having around 100k doing a traditional S&P 500 savings plan. Have a look at Arbitrum, for example. This is the number of ARB tokens over time that are circulating. When the supply expands and the demand doesn't expand at the same rate, then the price underperforms. Now this is Arbitrum in US dollars, and this already doesn't look that great, right? We have seen Arbitrum going down by 60%. But compare Arbitrum relative to Bitcoin, it's much, much worse. Again, because Bitcoin has all of those inflows from traditional finance, and because a lot of Bitcoin gets lost over time, and because Bitcoin does not have this ultra aggressive supply schedule. The number of Arbitrum tokens is expanding faster even than the number of US dollars. And that's why it's losing even against the US dollar, but it's definitely losing against Bitcoin. And so my approach to generate alpha out of this is to just flip this chart around. So instead of looking at ARB relative to Bitcoin, here's Bitcoin relative to ARB. So you're going short Arbitrum, we're betting on falling prices of Arbitrum, we're betting on rising prices of Bitcoin. And what we see in orange, this is just the Bitcoin price during the same time. So we outperform buying and holding Bitcoin massively with that strategy. For example, over here, since the beginning of 2024 to today, Bitcoin has appreciated by 164%, but Bitcoin relative to Arbitrum has appreciated by 678%. Now, this is way higher than the alpha that I personally achieve, but of course, I'm also rather risk averse. I don't bet the entire portfolio on a single token, and not everything that inflates as aggressively tends to also lose that constantly. But again, it's all about the long term. It's about building wealth over several years, not just speculating on what's happening next week. Now, granted, betting on relative valuations, so something going up while the other thing is going down at the same time, is a bit more complex compared to just buying an altcoin straight out. But that's why I made dedicated videos on the topic. There's actually only 2 videos that you have to watch. So there is this one over here, using perpetual futures to bet on relative valuations. And there's this one over here, risk management with relative valuation bets. It's 1 hour in total worth of content. And after you've watched that, you know how to set up positions like this. Now, there are bets that are a bit more risky than others. Arbitrum is rather risky. Just have a look at this drawdown here. But there are also more constant winners. For example, have a look at this. This is Bitcoin relative to Balancer. Balancer, again, being a very inflationary token. Here's my offer. You watch those 2 videos, you learn how to set up those relative valuation trades and how to do the risk management properly. And then afterwards, after you've joined the community, I will send you my favorite trade. So I've got several of those relative valuation trades open, but I will send you my favorite one. And if you don't make money with that favorite trade after 1 month of holding that relative valuation trade, then I will just refund you the membership fee. So this video over here and this video over here. And if you don't make money with that favorite trade, you will get the $125 back. That's the fee per month. I, of course, share every single trade that I make. I don't just share my favorite trade. I share all the trades that I make in real time to the premium members. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.